It's normally the fast-growing areas. I mean, the things that everyone loves, to be honest. I was actually looking at today, it was quite interesting, at some of the things that are really hot at the moment. I'll ask you a question. What do you think Zoom's market cap is?
10 billion?
It's 85. So Colgate's is 70 billion, somewhere around there, just to give you a reference point. So something like that, that's obviously a very good technology and we're all using it at the moment, but there are some substitute products. I think Teams is a pretty good product. We all moved very quickly to Zoom, which suggests to me that if Zoom doesn't deliver and another product becomes available, we will all move very quickly away from it. Relative to the profitability of the company, you're having to make a lot of assumptions on future growth, so we'll just stay away from something like that. Biotech is well out of our realm. We don't go near that. Anything that is very fast growing, where industry structures are very fluid, market share moves around very quickly, anything where you have to make a big prediction on the future, anything that's regulated or cyclical, we just take a pass. Comes back to valuation, I guess. So how much are you willing to pay for that structural growth? And how confident are you that that will still be the market leader in 5 to 10 years? So take a company like Moderna, which is developing the vaccine, one of the contenders. That's a $25 billion company, which is up against incredible competitors, and everyone's throwing money at the vaccine. So how do you know that they will be first? Will it be J&J? Will it be AstraZeneca? Will it be Sanofi? What most people always look for in investments is they look for growth. What we look for as more than anything else is competitive advantage and enduring competitive advantage. And I suppose in my career I've seen obvious growth stories not turn out to be obvious growth stories. So back in 2001, Nokia was the darling of mobile networks, peak market cap of $250 billion. It was obvious that Nokia was going to dominate forever. Nokia was eventually bought by Microsoft for $7 or $8 billion, if I remember correctly, and they eventually sold it for $350 million. So that's the potential to lose money is massive if you start taking on businesses at that valuation that don't have stable industry structures. I think if you've got a business that it goes back to what I said before, it's about enduring competitive advantage. So if you know a business is very stable and has endured lots of recessions, been through lots of tough times, and the most important thing is the reason that someone buys that product must be very, very slow to change, and the customer must be loath to change his mind to buy something else. So, for example, Sherwin-Williams, that's been going 156 years. What does Sherwin-Williams sell? Well, it sells paint. Well, that doesn't sound very exciting, really, paint. But what they're really selling is they're selling time and trust, because their product is available at 4 times more stores than you can find at their competitor in the US. And for a painter, the number one cost of a job, 85% of the job is labor, it's time. And they go into a Sherwin-Williams store, they know that the store managers are actually been around, there's 7% staff turnover, they've been around for a long, long time. Those managers have been dealing with them for 20 years. So I know that the reason someone's buying that is not going to change whether it's recession or not a recession. What for me is concerning is when I find a business that the reasons someone buys it are very easy to switch.